Hi everyone, welcome back to Zenova. And in this video, we're going to still stay in the option strategy and portfolio module. And we're going to go down to the portfolio editor and look at doing some what-if analysis on an option portfolio. So we're going to take the Apple option portfolio of a call and a put in this case and go through a little what-if analysis on that portfolio. So currently right now it's showing a value of about $11,150. Some of the overrides we can do is actually changing in this case, the date. So if we didn't want to use today's date, but we wanted to move maybe forward in time from where the actual pricing is. So instead of November 5th, let's say we went to December 5th or a month ahead and reprice this portfolio. We can actually see how the traded versus the new theoretical, the price would be decreasing. So we would get a value, a fair value, because of time decay. If we look, that's decreasing. So if we look here, we can see original traded value and the current value of where these options were trading. And now we can see all of a sudden that the fair value goes down to $395 versus $475 for the call. And for the put, it goes from $640 down to $551. So let's go back and just price it as today again. And we could change the expiry, but you probably wouldn't do that to look at European versus American of what a difference it could be, but you certainly could do it. You can make a new interest rate assumption. So you can say, what if instead of, currently what I'm using I believe is 0.01%, what if we used a 5% interest rate for calculating the option value? We recalculate and we can see that would have an effect of about $155. So for a short-term option, not a fantastic or great effect. We could also make an assumption of volatility. Let's say volatility on this portfolio increases and it currently stands at 30% instead of roughly where we initially priced it at 22.32 and 24.71. Let's bump it up to 30, recalculate. We can see that the actual value of those options then are going to increase with that new volatility assumption. And we can see that the one option here has gone up from 475, the call option to 655, and the put option has gone from 640 to 764, or a difference between what we traded at versus what the new theoretical is of $3,000. And then the theoretical versus the current obviously has gone up, so it would be a negative $3,000. And let's go back and net that out again. We could change an underlying assumption to using a different model and see how a model affects the pricing. We could change tree steps if we're using a trinomial and increase or decrease tree steps for getting a finer price. Or we could say instead of an outright volatility of what we have in there or overriding with 30%, we could say what if volatility increases, let's say 7% from where it currently is. So we put a volatility spread of 77% in there. We reprice. We can see the difference now is 3,293. And if we look over here, we can see what the new values are for both the call and the put. And that's how you use the overrides. It's very, very powerful in terms of looking at overall changes, making certain assumptions, looking at overall changes to the portfolio that you have created in Zenova.